Good afternoon, all, and thank you for joining us this afternoon. In another of our kind of wonderful firsts of the last year, I'm doing this webinar from my gym, as I wasn't expecting to be hosting this afternoon. But we will work with what we've got, and I think we're going to hear lots of interesting kind of reflections and information this afternoon. In my role, kind of as head of policy and external affairs at CHC and leading the finance SDG, I was just saying to our guests this afternoon that pensions is probably the issue that I get the most questions on, and I know it's an issue that affects lots of your businesses, and housing associations are constantly looking for answers. So I'm really pleased to be joined this afternoon by Stuart Price and Adam Cottrell from Quantum Advisory. They're going to give us a run through, I guess, some of the key issues in particular related to SHPS and LGPS this afternoon. I'm going to talk to you about how you can improve your balance sheet and deal with some of those issues. So without any further ado, I'm going to hand over to Stuart and Adam. If you've got any questions throughout, please do pop them in the chat or in the question bar on the right hand side, and we will come to those at the end. And I'll hand over to Adam and Stuart.
Thank you, Aaron, and also thank you to Community Housing Cymru for arranging today's pensions presentation. So what we're going to go through today is a look at improving your pension balance sheet and also an update on SHPS and LGPS. Now, myself, I'll be doing the presentation along with my colleague Adam Cottrell. We're both pension scheme actuaries, and we may be familiar to some of you. We've worked with a number of you in the past. But for those of you that don't know much about us, just a very, very brief synopsis on Quantum Advisory. We're an independent pensions actuarial firm. We have 5 locations in the UK, and Cardiff is our head office. We're Welsh-based, and essentially we help employers and trustees run their pension arrangements. We do it at the corporate level, and pensions is in our blood. That's all we do. And you can see there the services we provide. We provide the full suite of pension services. So we're very geared up to providing pension services to employers and trustees. So today's presentation, the main part will be in relation to financial accounting. And obviously, for those of you who are in the LGPS pension scheme, you may have already received your 31st of March 2021 pension disclosures for your company accounts. And for those of you in SHPS, we understand that they're imminent. They're going to be due over the next week or so in relation to the 31st of March 2021. So what we'll do is I'll give you a bit of a background, and then Adam will dive in, and he'll give a lot more detail. He'll let you know what's happened since last year, and he'll give you a feel for what he thinks will be disclosed this year, and then let you know what the process is, how it all works, and how you can potentially make some changes to disclosures and how you can review them, etc., for good governance. I'll then give you a quick update on SHPS and LGPS. On SHPS, I think spend more time on SHPS because we've got the funding valuation due very shortly, results of that, and that will have big implications on associations. So we'll give you an update on that, and also a few things happening at the LGPS. And then finally, we'll touch upon pension education and engagement for employees, something we're very passionate about. We've got one slide on that, and then obviously then welcome to open it up to everyone for questions. So what I'll do now is I'll hand over to Adam, who will go through the financial accounting bits. But before I do, I suppose maybe I should just give the update on the background and where we are. So financial accounting in a nutshell. So just a brief synopsis then. At the year-end date for most associations, 31st of March 2021, the association's share of either SHPS or LGPS assets, along with their pension liability, that's the value placed on the benefits promised to date, are calculated and are put on your financial statements. Now, this new method has only been applicable for SHPS employers since 31st of March 2019, so we're in our sort of third cycle now of doing this. LGPS has been a lot longer. And it's a very transparent method of what we do, and it's consistent with how other funded defined benefit pension schemes disclose their liabilities in their company accounts. And a key thing, again, which Adam will go on a little bit later, is that in relation to the assumptions used to drive these results, the association is responsible for the assumptions and can actually make changes, and you want to make sure they are right for your business. And again, a key thing to note as well is the result will be very different to the SHPS and LGPS funding valuation. So for LGPS, 31st of March 2019, you had your funding valuation and that drove what the employer pays into the pension scheme. For SHPS, we're going through that process now, results out due shortly, and again, that will drive what you pay into your pension scheme. What we're talking about here is a valuation in relation to what gets put on your financial statements and your company accounts. So a bit more of a background and context to valuations and what they mean and how they work. So way we do a valuation, so both the funding and also the company accounting one as well, is you look at the value of the pension scheme's assets. For the LGPS and SHPS, obviously each employer has their own share of those assets, and that's relatively easy for the actuaries to get. They can contact the investment advisors or the investment managers to get that. The benefit side is a bit more complicated, because what you have to do here is place a value on the benefits put up to date for every single individual member in the scheme. So that's the active members, those members who are still employed by the association, still building up benefits. Deferred members are those members who have left the association but have yet to retire, and the pensioners are those members who have already retired and are receiving a pension. As you can imagine, these pensions are going to be paid for 20, 30, 40, maybe even excess of 50 years' time. And to do that, we need to make lots of assumptions about how we place a value on those benefits. And in relation to company accounting, as I mentioned, the association has responsibility with guidance from the actuaries about what assumptions to use. And the key assumption in relation to company accounting is the discount rate. The discount rate is set using high quality corporate bonds, and that's the key assumption that will drive the value placed on your liabilities. Other assumptions we look at as well is things like mortality rates, how long your members are going to, your employees are going to live for, because obviously the lighter the mortality, the longer they're going to live for, the longer the pension will be paid and the higher value placed on liabilities. And also inflation is a very big assumption to use as well, because that drives how pensions increase before retirement and after retirement as well. They're all inflation linked. And so these assumptions have a really, really big impact on the company accounting numbers that get put on your balance sheets. So what I'll do now is hand over to Adam, and he'll first of all give you an update on what has happened since the end of March last year and where we are now. Thanks, Adam.
Thanks, Stuart. Yes, as Stuart says, I'm going to be looking at the key metrics from the financial markets that we look at, which drive the value of your liabilities and assets that feed through into your balance sheet. Thanks, Stuart. And as Stuart touched on, the key things on the liability side are how have corporate bond yields moved over the year? How has the expectation of long-term inflation moved over the year? And what's happened to our assets, because it's a two-sided equation. Thanks. So, as Stuart said, the discount rate is a really key assumption when you're deriving your pension scheme liabilities. And the FRS accounting standards require actuaries to base their discount rate assumption on the yield of high-quality corporate bonds. The discount rate assumption has the biggest impact to how your balance sheet looks at the end of the period. You can see there, a fall of 1% in your discount rate could result in your liabilities increasing by 20% or so. So you can really see the sensitivity of the results to that discount rate assumption. But what is it? Well, effectively, the discount rate is the assumption you use to estimate future return in your assets. So although the LGPS and SHPS schemes are invested in a diverse range of assets in their portfolio, the accounting standards require you to estimate the return of those assets based on corporate bond yields. So how have corporate bond yields moved over the period? So your last set of disclosures were at March 20, and we can see there the corporate bond yields are 2.3%. Now, a lot's happened to corporate bond yields over the year, but that's not so important for your disclosures at the end of the year, because we take the corporate bond yields that are derived from the market as at March 31st of March 2021. And you can see, although there was a big drop off in corporate bond yields during the year, they did recover, mostly during the first half of the first quarter, I should say, of 2021. So we had 2.3% corporate bond yields as at March 20, and overall during the year we've seen a reduction of about 0.2% to about 2.1%. So you can see that in isolation, that a 0.2% reduction in your corporate bond yields, could see your liabilities go up by sort of 4 or 5% without anything else happening at all. Thank you. And then the other key driver, I should say, of how your liabilities have moved over the year is what is the market's expectation for long-term inflation. So this is the inflation rate used to increase pensions in the future over the long term. Now, the way that the actuaries derive this assumption is by looking at the difference between government gilts and index-linked gilts in the market and deriving an implied inflation rate from that. The lower the inflation rate is, the lower future pensions being paid out are expected to be, and so the lower our pension liabilities are, and that works the other way around as well. And we can see that this year from the graph, market implied inflation has gone from about 3.1% all the way up to 3.7%. So there's a 0.6% increase during the year, which is very significant. And this graph shows market implied inflation relative to the RPI index, retail price index. But the majority of SHPS and LGPS liabilities are linked to consumer price inflation. That's a technical difference, but what that will mean, because of some of the reforms that have been announced to RPI over the year, it means that actually what we'll see is that the increase in the CPI assumption, which is the key one for your pension disclosures, will have increased by more than that 0.6%. So actually that increase will be more pronounced, and that will be more bad news for your pension disclosures. But we have seen that inflation risk premiums have been increasing over the year, and how inflation risk premiums work by saying, well, okay, the market expects a certain rate of inflation based on the prices of all these underlying investments, but we think that the prices of those investments have been distorted slightly because they're being so heavily used by really big institutions like pension schemes, very large pension schemes, and insurance companies. So because the demand for these instruments is so great, it's artificially pushing up market implied inflation. And so we're seeing more and more over the last certainly 5 years or so, we're seeing inflation risk premiums which reduce the rate of long-term expected inflation being used to a greater degree, but also the inflation risk premium itself increasing, meaning that the reduction you make to market implied inflation is greater. So that'll help. So what I'm saying overall here is that the long-term expectation of inflation has increased significantly over the year, albeit there'll be a little bit offset by an increase in inflation risk premium. Thanks. And then we got to look at the other side of the equation. So we thought about the liabilities. What about the assets? Because your balance sheet is obviously a calculation based on both. And you can see on the screen there a graph of the performance in global equity markets over the year. So March 2020 was the height of the first wave. Investment markets plummeted at that point in time, equities especially. So what we've seen since then over the year to March 21 is a gradual improvement and a very, very positive improvement in the value of those assets. So much so that global equities, we think, have increased by around 60% over the year, which is very, very significant. Now, you need to think about the SHPS and LGPS assets that you've got, and those assets aren't invested 100% in global equities like they may have been many years ago. Now, these big pension schemes are using much more sophisticated, diverse, and typically more cautious investment strategies than being very bullish and investing everything in growth assets like that. And the effect that will have is to dampen down the performance of those equity markets. So we won't see the value of your assets in your disclosures increasing by 60%. Unfortunately, it'll be much lower than that because of all the safe assets that these big pension schemes invest in. So what does this all actually mean? Well, we've looked at the liabilities and we can see that the discount rate has fallen, long-term inflation has increased, and both of those measures will act to increase your liabilities pretty significantly, I would have thought, over the period. But positively, on the asset side, we've seen a very big improvement in asset values, and that'll help to reduce some of the negativity from the increase in liabilities. We think overall it will vary from scheme to scheme, but probably overall the increase in liabilities has outstripped the increase in assets. So it's probable that there's going to be a deterioration in your balance sheet position as at 31st of March 2021, unfortunately. Thanks. So now I'm going to take us through the process from receiving your disclosures from the actuaries all the way to what you actually disclose in your company accounts. So as Stuart said, you know, the LGPS results, disclosures and assumptions have been released now, and SHPS are coming very, very soon. So everyone will have their disclosures in their hand very soon. And you've got a key choice to make at the start. So you've got your disclosures from the actuaries. You know, you need to note that these are provisional assumptions and provisional disclosures, and just one actuary's view of your funding position. And the choice you need to make at the outset is, do I accept these provisional results and assumptions and put them into my company accounts, or do I carry out a simple review to see A, whether they're appropriate, and if they are, then fine, I can use them, but I've got an element of comfort that they're appropriate, and B, if they're not appropriate, then what can I do, what can I change, what assumptions can I change, and what impact does that have on the disclosures that I will enter into my accounts. And then of course the final step will be to recalculate your disclosures and to put the agreed results into your company accounts. You know, a key concern I think employers have around this is, okay, carrying out an actuarial review is going to add time to the process, but I think in reality, from the point of request to delivering the advice might be a week or so, and could be quicker if you've got internal deadlines. It's a pretty quick process, and can be done to suit your needs, I suppose. And the other thing to bear in mind is that, yes, okay, your proposed assumptions will be scrutinized, and changes will be suggested. They then need to be run through the models again to get your disclosures. But for the SHPS scheme, you can do that in real time yourself with the online modeler. And for the LGPS scheme, you can get the actuary to provide you with those results pretty quickly. You know, this is something that's done regularly by the individual LGPS funds for lots of employers. You know, so it's no problem really. Thanks. Okay, so how do we make changes to your disclosures then? So an independent actuarial firm will look at the disclosure that you've been provided with, and will provide some advice. But why the actuarial advice is so key is that you can look at those proposed assumptions and resulting disclosures and see whether they're right and reasonable. Each association has the responsibility to ensure that the disclosures they're putting into their company accounts are right and reasonable, and an actuarial assessment will help you justify that. If they're deemed to be not reasonable, or if changes are suggested to certain individual assumptions, then the actuarial advisor will identify those changes, and they'll tell you what impact those changes will have upon your disclosures. You know, how will we see our balance sheet position move? What impact will that have to next year's pension cost, etc. And of course, a review from professional advisors will be sufficient justification for auditors if they come asking for justification around the assumptions that you're using in your disclosures. As I said earlier, the changes can be really significant. A small change in the discount rate assumption can have a massive effect to your balance sheet position. And we've got an example of that now over the page, where I'll take you through an example housing association results and some of the things that could be done to adjust those results by scrutinizing the individual assumptions. This slide shows you the results both last year and this year. It's key to remember that you can't amend the results from last year, and you can't amend the value of the plan assets either. They're set in stone, and they're not subjective. But the subjectivity comes in with the valuation of the pension payments and that defined benefit obligation and the resultant, and then that follows through, of course, to the balance sheet. So these can be scrutinized and adjusted if it's reasonable. And remember that the assumptions that are set by the actuary, these are really big pension schemes with lots and lots of employers. So the assumptions themselves inherently are generic, because they cover a lot of different employers. And what's useful from the actuarial review is to look at those individual employers and perhaps take a more bespoke assumption to the generic one that's being made, to make sure that the disclosures that are calculated at the end of it are more relevant to your individual situation. Thanks. Thanks, Stu. Next. Okay, great. So what did we look at then? So as I said, the key assumptions are discount rate, that future expected rate of asset return, and also inflation, because that drives the pension increases in payments, and also the level of salary growth, because that's usually derived based on the inflation assumption. And you can see here in this example, we were able to look at the individual association's membership and say, okay, well, it's not as mature as the general membership, and the duration is longer. That way, we're able to take an average investment return over a longer period, and that longer period investment return or discount rate was higher than the proposed discount rate by the actuary. So you can see that the proposed rate was 2.35% for the discount rate, and we deemed a reasonable assumption to instead be 2.6% for this particular employer. That 0.25% increase in the discount rate reduced the pension obligations by about 5%. So a really big impact for such a small change. We looked at the inflation assumptions of this particular scheme, and we thought broadly they were reasonable, actually. And we didn't propose much of a change to them, although we did think that perhaps they were a little bit too high. So suggested that the inflation assumptions and resulting salary growth assumptions were reduced only by 0.05%, but that still had a 1% reduction on pension obligations to the balance sheet, which is really positive. Thank you. And then, so they're the financial assumptions. Then we looked at the demographics of demographic assumptions. We thought that the first two, the cash commutation and the pre-retirement mortality assumptions, were reasonable as well. So we didn't suggest any changes to those. And broadly speaking, the mortality assumption was fine, albeit we did think it was a little bit prudent. We thought the general assumption was assuming members lived longer than was reasonable, really, bearing in mind the demographics of this employer. So we suggested that the long-term trend rate was reduced, which meant that life expectancy assumed in the disclosures was lower. And that gave an expected reduction, or a reduction of 2% to the defined benefit obligation. And in aggregate, all of those changes amounted to about a 9% reduction in that DB obligation, meaning that there was a significant improvement in the balance sheet position. You could see there that the present value of defined benefit obligation under the proposed assumptions was about 14 million, and now we're under 13 million. So that's a £1 million saving in our pension liabilities, which has improved our deficit by £1 million, improved that deficit that's disclosed on your balance sheet. So that was really good news for that employer. So, okay, so you've gone through this actuarial review. You've got a revised set of assumptions, and you've managed to obtain the results based on those assumptions, which is great. You now need to go to the association's board and committee and need to get approval of those assumptions. You need to make sure the auditor is on board with the assumptions that you've adopted, whether that be the provisional ones or that be the revised ones that you're adopting, and then incorporate finally the agreed changes into the financial statements that you're disclosing this year. But the key thing is actuarial advice, independent actuarial advice throughout all of these stages, really. It can help you with any one of those stages. Thank you. Okay, so my final slide is just some takeaways on everything I've said. I think the most important things to remember are that it's the association's board's responsibility to use appropriate assumptions in your accounting disclosures. And you need to be able to justify those. And we think it's best practice to review those provisional assumptions that you're provided with before you adopt the results. So you're sure around the results that you're putting in your financial accounts. Any changes that come out of an actuarial review can result in balance sheet improvements in this year's disclosures. You know, remember that it's not just good governance, but it's also potentially a way to improve the position. And any changes could result in your pension expense for next year's disclosures being lower as well, and having improvements there. And of course, as we said, even if the provisional assumptions are deemed appropriate, and they might well be, the review can be used for used as justification for auditors as well. You know, so it's all very valuable stuff.
Okay, thanks, Adam, for that insight into the company accounting process. What I'm going to sort of touch upon now is some quick updates on SHPS and LGPS, but I'll be spending a little bit more time on SHPS, and and the reason being we have the 30 September 2020 SHPS funding valuation pending, and again, as a reminder, this is the valuation that will drive what the association and what employees have to pay into the pension scheme over the next few years. So it's quite key for associations to get an understanding of what likely will happen. And we understand that results are going to be formally available in the next few months, with then individual letters going out to employers, hopefully in the summer, to look at what the implications are on your contribution rates. But what we can do is give you a feel for how we think you are, to give you a bit of a heads up. And so this slide here is similar to the slide Adam looked at earlier on, but here we're looking at the period 1st of October 2017 to the 30th of September 2020. So it's the start of the last valuation date and this valuation date, and what's happened in between. What we want to know is what's happened at the start and what's happened at the end. What happened in between doesn't really matter. It's the starting and the ending endpoints which are key. So you can see at the last valuation, gilt yields on the left-hand side in this graph, the red line here, were around about 1.7, 1.8%, and they've now come down to around about 0.5, 0.6. So, as a reminder, gilt yields, they drive the discount rate in funding valuations, and when gilt yields come down, the value placed on the pension liabilities, the benefits promised to members, goes up. So you can see by looking at that slide in isolation on the funding side, the liabilities will go up, which will mean the deficit will go up, which will mean more contributions are required from associations. On the right-hand side, then you've got the implied long-term inflation. Again, as Adam was saying, this is the market's expectation of long-term inflation, because benefits are paid for a long period of time. And as you can see by looking at the starting point from last time's valuation and this time's valuation, the end point of the graph, you can see inflation has come down ever so slightly. So when inflation comes down, because benefits are inflation proofed, if inflation comes down, the value placed on the liabilities comes down as well. So that will reduce the values on the pension liabilities. But compared to what's happened on the left-hand side, the gilt yields, that inflation drop really doesn't touch the sides. Based on the liability side, look at the two graphs, the liabilities at this valuation will be significantly higher than they were 3 years ago. At the bottom, though, as well, we need to look at what's happened to assets over the 3-year period. And as you can see, they've been trundling along, increasing, and then with the pandemic back in March last year, they plummeted down, but are fully recovered now. But even still, assets overall have increased by around about 20-25% on the global equity return. So again, which is good, strong return. But as Adam alluded to earlier on, in the ships, it's had a diversified asset portfolio, some quite defensive assets. So again, you only expect to see some of this positive gain coming through. I think the assets will have helped the position slightly, but overall, though, that drop in the gilt yields will mean, I think, that deficits haven't reduced as we were hoping. And this is really compounded further by this graph and this slide here and this table. So the pensions trust that run the ship's pension scheme, as well as providing detail of the valuation, as you can see, 30 September 2017, the last valuation was done. They provide annual updates as well, so a broad brush calculation about where we think we are. And helpfully as well, they provided a broad brush approach as at the 30th of June last year, just 3 months before the valuation date. And as you can see by looking at the 18 and the 19 numbers, deficits went down and then came back up again. And then as at the end of June last year, you can see the deficit is broadly in line with where we were back in the valuation 3 years ago, September 17, of around about £1.5 billion. Now, a key thing to note is that, employers have been putting money into the schemes over the last 3 years to eliminate this deficit, to reduce it. So you would expect in 3 years' time for that deficit to have come down, but you can see it hasn't come down. So we're not on track. We're not expecting, we're not where we expect to be. And I've looked at the 30th of June numbers and then looked at the 30th of September numbers and get a feel for what's happened since that 3-month period. And not a lot's happened really. So I think the valuation numbers, I think of the £1.5 billion deficit, I think it's a good proxy for where we would be as at the 30th of September 2020. I think that's a good indication of where we would be. So what it means is that as the ship deficit of £1.5 billion hasn't reduced as expected, I think that more than likely deficit contributions are likely to have increased. I think the actuaries can take account of something called post-valuation experience of what's happened since September 2020 up until the valuation signed off. But even with that, though, I think deficit contributions are likely to increase. And obviously, as you know, for employers, that's a cost to the employer. That can't be passed across to members or employees. And so what you're paying to the ships in relation to deficit contributions, I think, will increase at sometime this year or early next year. Also, for those employers that still have the defined benefit sections open to accrual, there's no doubt in my mind, by looking at what's happened to the financial numbers, that the cost of future accrual will increase as well. Now, associations only think about how they address this future cost, future benefits. What can they do? They could close the defined benefit scheme down, or they can share some of this increase with employees or pass it all to employees. They've got a wide range of options. But what it tells me, though, is I think that ships DB maybe will become unaffordable for associations, and certainly for some of their employees, if these rates are coming through, we'll see, will certainly become unaffordable and maybe unattractive to employees who have got defined benefit accrual within ships with associations. So let's sort of delve into this in a little bit more detail. So what this slide here just shows you for the defined benefit section in ships, the different sections that are available. So you've got the 60th final salary, 80th final salary, 60th care, 80th care, and 120th care. This is a range of options that the Pensions Trust make available to employers. And the existing rate is the contribution rate overall that is currently being paid to pay for next year's benefits for these sections that are still open to accrual. Obviously, each association decides about how much the employer will pay and how much employees will pay. But we think that a 20% increase in that overall rate isn't unreasonable. And so what we've done on that table there, the bottom row, just to give a feel for what we think the potential overall contribution rate could be in due course. And you can see there's quite significant increases in costs there. And we think these rates are likely to come through depending on how quickly the Pension Trust can finish off the valuation and get the information out to employers, likely to come out at the end of this year or maybe the first quarter of next year. But as I said, though, in relation to the cost for future service, associations have discretion as to what it and employees will pay. When it comes to that deficit amount, they have to pay that, can't pass that on. When it comes to the future cost, though, it can change. It can split it out between itself and employees. And also what the associations can now do, a lot more flexibility compared to a few years ago. They can offer a range of sections available to their employees. So what you may find is that maybe, you know, the 60th care becomes maybe unaffordable for a lot of individuals, but maybe the 80th care is affordable. So employees can move from 60th to 80th care for future benefit provision. Those sort of flexibilities and offerings about what you provide your employees is something I think that employers will need to consider. But obviously, any changes in relation to contributions or benefit structures, again, employers have to consult with employees, and again, the usual 60-day consultation will be required. And something else I'd like to bring out as well with employers is in relation to the final salary sections. Again, they're getting less and less common, but some employers still have those. And a question whenever I speak to employers is this value for money for both the association and employees? Because a 60th final salary compared to a 60th care, if an employee who's in the 65 salary section, if their long-term salary expectation is that, you know, salaries will increase broadly in line with inflation, then no doubt in my mind, being in 60th care will give that individual broadly equivalent benefits, but at a lower cost for both the individual and the association. So again, if associations have final salary sections, I do urge them to look at the demographics of their members in that to see whether or not it's actually worth continuing those sections and maybe just offering care going forward. Obviously, one extreme thing employers can do is close down DB completely and move to defined contribution. Well, if you do that, beware of this debt on withdrawal. You know, this number that crystallizes debt, this funding debt, which is done on a prudent basis, could crystallize. But obviously, a way to manage that, though, is by moving employees into the SHPS defined contribution section. And that means then this debt and withdrawal number would go away and wouldn't be any issue for the employer. But again, you know, what this slide is telling me is, though, that, you know, there's quite a lot to think about for employers, and no doubt, you know, costs will increase. So I suggest that employers start thinking about maybe what they would like to do or some thoughts around it, so they've got their ducks lined up really. So when the results then do come out from the Pensions Trust, they can move relatively quickly in relation to consulting with employees and then potentially making any changes to make sure things are done within the required timescales set by the Pensions Trust. That's a quick update on SHPS. Now on the LGPS. Not so much happening on the LGPS because there's a big funding valuation was done at 31st of March 2019, and then new contribution rates came in from 31st of March 2020. And again, from our experience, what we found was that for employers, the results were better than expected, which is obviously is good news. But the question, though, is that a blip or a longer term trend? Well, certainly, you know, if we were to do the numbers today, then you know, I think the valuation would be worse, and their contribution requirements from employers would be higher. However, we are in unusual times with the COVID-19 pandemic, etc. So maybe things will sort of stabilise over the longer term. And we also have these cost cap valuations in place as well, which looks to provide sort of stable contribution and benefit structures over the longer term. Interesting to see, you know, how that all plays out. Then we've also got the McLeod case. So as a reminder about the McLeod case, you know, the public sector schemes, including the LGPS, back in 2015 moved from final salary to care, but protections were put in place for older employees to remain in final salary, called transitional arrangements. Younger employees thought that was unfair. There were some court cases, especially one with the firefighters, and what resulted was, yes, that was age discrimination. It was unfair. And so what's transpired now is that for employees that have LGPS benefits accrued from 2015 to 2022, when they ultimately come to retire, that 7-year period, the administrators will have to do a best of calculation of whether they should get care or final salary. And what that will mean is there'll be additional liability on employers in the LGPS scheme for this. So far, the numbers you see that they're not huge, but again, it's something employers should be aware of and make sure they've been included in their company accounts and on their balance sheet, etc. But again, it's something maybe you want to raise with your local LGPS authority about how that has impacted your liabilities in the LGPS. And then lastly, on LGPS, I want to touch on debt on withdrawal. Again, there's been quite a bit of news about this. So just as a reminder, if you're in the LGPS and you were considering exiting and stopping all accrual going forward, then what that means is then what the LGPS would do is they would crystallize the value of your obligations, your benefits, your liabilities on a very prudent basis. And essentially what it would mean is you'd have a debt that would need to be paid out to the LGPS, and that debt could be quite a significant amount. Well, these new regulations that have come in force give a number of options. So if you've got a very strong covenant, then the LGPS could treat you as a deferred employer status, which means you sort of remain in the LGPS and just have to pay deficit on a funding basis, which would be a lot lower and a lot more manageable than an exit payment. Alternatively, they could say that maybe the exit payments, you could pay it over a period of time, maybe 5-10 years, to help manage the process. Or maybe if you've got a very weak covenant, they say, well, no, we still want that debt paid up front, or maybe want some sort of guarantee in place. But these options here are still all discretionary, depend upon each LGPS local authority. So again, even if you're an employer and you've currently got no intention of leaving the LGPS, which many of you have, I would say though it's worth finding out, what options are available from your LGPS authority, and maybe lobby them to make sure that you can have the full options available at the point in time that maybe you do need it. So again, it's something, again, maybe you should be on your radar, and maybe something you should be thinking about and talking about with your local LGPS pension arrangement. That's a quick sort of look at some LGPS considerations. And my very last point now really is looking at pension education for employees. I've got one more slide in this, and something we're very passionate about as a business is going into the coalface and talking to employees about their pension benefits and trying to make a difference. And I think it's something that employers should really be trying to do, because these days many employees have got defined benefit, defined contribution schemes that they're a bit confused about what they all mean, how they all work, etc. So I think it's very important that employers help their employees understand how their pension arrangements work and what the likely benefits they can get from them. And in addition, in the housing sector, compared to maybe the private sector in general, the pension benefits you offer your employees are far more generous. So again, as employers, I think it's something you should be shouting about to make sure that your employees understand about the good pension provisions you employers put in place for them. As part of these education sections as well, what we find is employees actually don't understand the fact that actually being in a pension scheme, the cost is a lot lower than they may first perceive, due to the fact they get tax relief and national insurance relief if you have some form of salary sacrifice arrangement. And we can also explain to them about the benefits of paying more, and why you would do it, and what that could mean to you when you come to retire, the fact you could retire earlier, or maybe retire with higher benefits. And again, it's quite surprising that many employees don't appreciate the fact that being in a defined benefit scheme with an association provides life assurance protection too, if they're to pass away whilst working with an employer. Again, it's a very, very big benefit, and lots of them are unaware of that and maybe have gone out and got their own life assurance too, maybe over and insuring themselves and paying a cost they don't have to. So again, it's just shouting about what benefits are available within the pension offering you give to your employees. And how can you do this? Well, you can do it written or face-to-face. To me, I think face-to-face is by far the best way of doing it. You can do it at an individual level or a group level. I think a group level, again, is a lot more cost-effective. And again, in the past, we used to do it by going in and speaking to employees at the workplace. But now with COVID-19, you can do it virtual as well. And doing it virtually as well, you get maybe sometimes a bigger uptake, because maybe it's easier for employees to actually sit at home on their computers and listen to the talk and then ask questions about their benefits. Again, this can be done in isolation, or it can be done as part of maybe any consultation or changes you're going through as a result of what we've gone through maybe with the SHPS benefits over the next few months. But again, that's something I would, urge employers to think about it, because more employers are doing this now. I think it's so important that individuals understand their pension arrangements, how they work, the options they've got available to them, and what they can do to make a difference. Again, something we're very, very passionate about here at Quantum. So that's the end of our session. So I hope you've found it very useful. And I'll now hand back to Aaron to find out if we've got any questions or not.
Yeah, thanks, Stuart, and thanks, Adam, as well. It was a really thorough and really informative run through of lots of the issues that organisations are facing in relation to pensions. If you've got any questions, pop them in the chat or the question box on the right-hand side, and we'll kind of work our way through those. We've got 10-15 minutes before we need to wrap up. Stuart, I just want to pick up on the final point, really, which feels really important. I think, despite, and I'm not sure how many years it's been now, of kind of compulsory enrolment, we still see messaging around pensions is quite complicated. Lots of people don't really understand where that money's going, how they'll benefit from it. Have you seen any kind of messaging that really lands with staff around the importance of that? And as well as kind of continuing that dialogue on an ongoing basis that works in terms of bringing people on board?
Yeah, again, I think it's, again, I think, you can do written communications, and yeah, I think, we spend time in the industry writing things, and I think, we got to hold our hands up sometimes, and it can be too much jargon in there. People receive it in the post and they just don't understand it. I am very much that it should be face to face. You look you on the eye and talk to them in simple terms about their pensions. And I think the way I start off is I explain to people the state pension and the way that works and what they can get from that, and the fact that the age is going up and up and up, and that could change any point in time. And given the fact that we've had the pandemic of COVID-19, I can only see that going one way: the age going up and the amount you're going to get going down. So it's crucial that you save independently for a pension, and especially if you want to retire at a decent age. And we've got things coming out now, again, initially, which is good, something called the Pensions Dashboard, which will be a universal wide portal where someone can go on, put in their national insurance number, say, for example, and it will show you what they get from the state, what they get from all their different employers, because again, employees, you have different jobs these days. It'll show it all in one place and give them a feel for the benefit they can get at retirement. But it's so difficult in the pensions industry to engage with people, because people are turned off by pensions a lot of the time. And there's also in the press as well with pensions. Whenever it's in the press, it's bad news. You hear about BHS, or you hear about employers going under, having big deficits in pension schemes. There's never any good news stories about all those good pension schemes out there, which on the majority, the SHPS pension scheme, the LGPS, they pay really, really good benefits to their members. They give good security, etc. And really, it's just educating people, and that's why I think we need to do it maybe in schools initially with the younger generations, but then when we come to the workforce, I think employers really need to take a hands-on approach, really, and help their employees, educate them on their financial, thinking about the financial implications of coming up to retirement. Because the key thing as well is, sooner you start making changes, the bigger impact it has. When you're younger in a defined contribution scheme, the sooner you can start paying a higher contribution rate, the bigger impact it has. And again, it's getting that message to the younger generation, really, getting them to sort of engage in making their pensions. So it's a very hard thing to do, but something as an industry we're trying to do, and we're trying to make sure that when we do write out to the individuals, they're more engaging. There's more pictures and graphics, less words, because again, you find sometimes you get a pension letter through, and there's pages and pages of notes and assumptions, etc., which certainly turn people off and make it very hard for them to understand. So it's something I think we're working on as the industry. We're trying our best, but myself personally, I think the best way to do it is actually eyeball people and speak to them verbally about their pensions and try and get them engaged that way.
Great, thanks, Stuart. And I think there's lots there about kind of demystifying the language, isn't there, and really making this kind of accessible. I know that some of the stuff that's landed most with me has been kind of seeing people posting their personal experiences with pensions, actually, and there's the real life stories feel important. I got a couple of questions in the chat. A couple from Brian Pickett first, around the discount rate and why can't a consistent discount rate be applied for accounting and valuation purposes. And just to add to that, because the question is also from Brian, the second question from Brian is, do you think the past deficit contributions should be spread across a longer period?
Maybe Adam wants to do the discount rate on the company accounting, and I'll answer the bit about the deficit contributions.
Yeah, well, the discount rate, or how you derive the discount rate, will depend on the type of valuation you're doing. The trouble is with the FRS 102 disclosures and deriving your discount rate that drives your balance sheet position, that is dictated purely by the FRS 102 accounting standards, and you have to follow those standards as a base, at least, so you must use corporate bond yields or high quality corporate bond yields as your base, and there is some subjectivity around the duration of your liabilities, how immature or mature your population is, and whether you can play at the edges with that, but the base has got to be using corporate bond yields. And the thing is with valuations is you don't have that restriction, and typically they'll use gilt yields, and with valuations, because it's an exercise in timing the contributions coming from the employers and employees into the fund to make sure that there's enough money in the fund in the long term, typically there will be a level of prudence built in to that discount rate, which will mean that if there's any adverse experience in the future, the fund hopefully will be able to ride it out because it's built some caution into the amount of money that it's bringing in. So there's different objectives for the two types of valuations, and that mainly dictates why the discount rates have to be different.
I suppose I've got some sympathy in Brian's question. Because, like, it is, difficult for people to understand why, when we do a valuation, it's not one valuation, we do something like 4 or 5 different valuations, and it's, why you put in one number in my accounts, whereas actually then ultimately the funding valuation is showing something completely different. And I totally appreciate that can be very confusing, but it's just where we are at the moment, and we have to follow what the legislation says. In relation to deficit payments and paying back deficit, ultimately there's a number of things you need to think about in relation to that, and one of the big things is the strength of the covenant. So the stronger the covenant of the employer or employers backing the pension scheme, generally the more flexibility you have, and the longer the recovery plan period can be. Because if you've got a very weak covenant, and essentially what the trustees will want to do is try and get that scheme as well funded as quickly as possible over a shorter period, in case then something happened to the employer, when, say, for example, they went insolvent, and therefore then the pension scheme then could sort of survive on its own without having to go into the lifeboat fund called the pension protection fund. Now, looking at the ship's pension scheme and the fact that you've got 500 or so employers, all I suppose of different financial strengths, etc. But ultimately, though, I think it's when you compare to the private sector, I think it's a strong covenant. I know as part of the valuation process, I think the employers committee were looking, I think they maybe engaged with PwC to do sort of an overall industry-wide covenant assessment. So I think depending on the outcome of that may help maybe allow the trustees and the employer to come to agreements, the employer committee to come to an agreement whereby maybe that length, that recovery plan where the contributions are paid back can be extended, which would mean then the amount needed each year would come down. So again, it's a good question to pose, and it's interesting to see what comes out of this valuation in relation to that recovery plan and the covenant assessment.
Great, thank you both. I've got a couple of final questions here, I think. I really like the question from Neris, so I'll leave that to last. But Simon has mentioned on slide 30, and someone was keeping count, it'd be interesting to see the gilt yields from valuation date to now. So perhaps that's something that can be shared after the webinar. Simon's also asked a question around defined benefit. Market conditions always seem to be against DB pensions nowadays. Do you see a future for DB, or is it just too risky and uncertain now?
I actually go back to his first point about the gilt yields. He's right. Since the valuation date, gilt yields have come up, and so when we do valuations, you can take into account post-valuation experience. So it won't actually impact the results at that valuation date, but it will mean when you come to look at the recovery plan, etc., you can build that in. It's a bit like extending the recovery plan payment period as well. But again, that's something we'll happily share after the session. In relation to DB schemes and risks and etc. There's no doubt in my mind that defined benefit pension schemes are for sure the gold standard for individuals, for members, for employees. They are the best ever schemes there. They give them a guaranteed benefit for life, inflation proofing, the option to take tax-free cash at retirement. But the risks, though, for employers and the cost are forever being increasing. It's the burden being put onto employers is just ever increasing, and you can understand why employers are coming out and getting rid of that risk. We're trying to crystallize the risk and not take any more risk. You've still got some employers out there that's still happy to take that risk on, etc. But it's a difficult one. My heart says keep DB going because it's good for individuals and it gives them the best outcome. But my head says from an employer perspective, for a lot of them really, it's a big risk to take on, and that's why these schemes are on the rapid decline throughout the UK. I don't know if you've got any other comments to add to that, Adam.
Yeah, well, you're bang on, really, aren't you? Employers don't like the risk, don't like the costs, and are headed towards DC. I think if that is the way that the employer takes their particular pension provision for their employee base, then it's very important, as we were sort of saying before, to try and offset some of the reduction in benefit value, because that's effectively what you'll be doing. If you move from DB to DC, it'll inevitably be a worse pension scheme for the individual, unless you pay significant contributions into it. But then there are things you can do from an employer's perspective to try and soften that blow a bit. So making sure that the contributions you pay in are generous is one thing. And engaging with employees again, going back to that. So if you've got a youngster paying money into their defined contribution scheme, you know, from a young age paying in good money, then they're much more certain of or much more likely to have a good, generous retirement outcome than somebody who starts thinking about pensions in their 40s, realizes, oh, it's quite late, and then starts piling money in. So because we're moving out of a generation that started with DB schemes, you know, you join an employer at 16 and they sign you up to the DB scheme and you never have to think about it again. And you were happy with what you got out at the end. You know, things have changed massively. And if you are an employer that's providing a defined contribution scheme, I think it's really important and really valuable and can help to offset that reduction in value to members by engaging and educating the workforce, you know, as early as you can, maybe at the point of employment.
That's brilliant. Thank you both. And the final question here from Nerys and Jones is, I think, a really good one. And we talked a little bit about this, about demystifying pensions from a kind of end user point of view. But I think it's also important from a business point of view, isn't it? So board members and others, I'll raise my hand on this one, often get confused between the FRS 102 valuation and the fund valuation. How would you best explain the difference in layman's terms?
In layman's terms, then, so I think, you know, the funding valuation is the one which is set by the trustees of the pension scheme, and they have to use prudence in that valuation. It's legislation, and that's the one that drives the contribution that is ultimately paid by the employer. Whereas the FRS one, again, that one, the basis you can use there, they say it can be a best estimate basis, so less prudence, but your discount rate, which is the assumption which is, has the biggest impact, has to be derived from the yield on AA rated corporate bonds, and that one is the number then actually then gets put into your company accounts. And it's so confusing for lay people because, as I think I said earlier on, you know, you've got one number going in your accounts that may show a surplus, and another one on the funding basis, you've got deficit and you're paying extra contributions. You know, why is that? You know, it's very hard to understand. So again, you know, in the past, we've got experience of going to boards and actually sort of going back to basics and explain that difference to them as well in layman terms, so that then actually then it helps them grasp the issues, understanding. And you've also, which you haven't mentioned there, got the issue of debt on withdrawal, and what does that mean as well? And that's another question for maybe for another day, which boards need to understand as well, again, about what the obligations of that are.
Great, thank you both. And no further questions. So I think all that remains really is to thank you for the webinar today. Some really interesting insights and lots of really helpful information, I think, for our members and for me too. I certainly learned lots in the last hour. Thank you everyone else for attending. If you've got any follow-up questions for Stuart or Adam, you can see their contact details on the slide there. We will also share a recording if you want to share with colleagues who might benefit from this. And you'll be able to get in touch with Quantum through CHC or through those contact details there. So thank you all, and enjoy the rest of your day.
Thank you. Bye.